I am so excited to be here with my friend Joey from a warm 29 degrees in Dallas, Texas. I can only imagine what it is like on your side. And obviously, on behalf of us Cowboys fans, Joey, we feel your pain and sorry for the Lions' rough go this weekend.
Thank you.
um,
Thank you for the empathy.
I know you were you're instrumental in that team. I believe the Agrees have an ownership stake in the company. Um,
No.
I have a deck that I've put together, and you and I have talked about some of this stuff. I'm going to let you basically run with a lot of this. But why don't we just go ahead in the interest of time and hit the ground running? You do see my screen, is that correct?
I do.
Excellent. Well, let's start from a very high level, Joey, as we talk about your most recent investor presentation. You provide a great snapshot looking at your top tenants, the retail sector exposure. There was a great article in the journal today looking at omnichannel retail. I know we're going to spend a huge portion of our presentation today talking about your rethinking retail strategies. You guys take a much different approach, obviously, as a multi-billion dollar enterprise. But I think we're going to get some really good stuff here, especially as you note some of your success stories that we'll walk through, like a Tractor Supply and how you've been able to avoid troubled tenants like what we've seen with Walgreens. And so we're going to hop into that. But Joey, let's start from a very high level. You guys reported at the end of the year that you own over almost 2,400 properties in all 50 states and almost 50 million square feet of gross leasable area. Joey, let's rewind in time. How do we get here? Walk us through maybe the backstory of Agree, and how we got to this point today.
Sure, rolling the clock all the way back. My father took the company public in 1994, 16 community-anchored centers by Kmart. And Kmart's former headquarters, about 5 miles away from here, was the world's largest retailer. He put 16 of those assets into the IPO in 1994, and then proceeded to be a developer for Borders, which was based in Ann Arbor. Hopefully everybody remembers that wonderful bookstore. And then with the advent of the freestanding pharmacy, started developing for Walgreens, freestanding pharmacies on corners, as we all know today, with drive-throughs. In the mid-late 2000s, I came to the company, continued the development platform, and then in 2010, launched our acquisition platform. At the time, we had 10 FTEs, including myself and my father, 72 properties in 16 states. 75% of our NOI, or net operating income, was from Borders, Kmart, and Walgreens. And I saw the need to quickly diversify. We were obviously coming out of the GFC. Borders was on its last leg. Kmart, we all know what happened there after Lampert slammed Sears and Kmart together. To quickly diversify, access the public capital markets, and really change the trajectory and the strategy of the business. The last 15 years have been almost 15 years now, have obviously been a whirlwind. We've invested, I think it's $8 billion now since the launch of that acquisition platform. We retain our development capabilities. We have our developer funding platform where we work hand in hand with other private developers to finance and own their projects. And then acquisitions obviously is the largest component of our investment dollars on an annual basis.
Joey, did you grow up in the business, or did you, when you came out of college, did you go straight into the family business? Did you ever do anything else in the world of real estate before this?
Yep, straight out of college, I went to law school and then worked my second and third year, and during and after the bar at a private developer working on predominantly power centers and then large mixed use projects. We developed about 15,000 residential units
Do
as
you still
well.
have your law license?
I do. If you go end up in jail, I can come visit you, but that's about it. I can skip the line. I've got my bar card. Never practiced, never intended to practice law, but my father always stressed just the education, the background in contracts. And I think more importantly, which is really proven correct, is just the linear thinking, right? A to B, B to C, right? If you go from A to C in real estate, you skip step B, especially in our business, that can lead to really poor consequences. And so Look, today we sit here as a $11 billion enterprise, as you mentioned, 50 states, 2,400 properties, but 80 team members still based here in Michigan.
Let's go a little bit more into it because you did briefly touch upon your investments. Can you walk maybe through some of the investment criteria, looking at all the transaction activity last year, your outlook for this year, looking between 1.1 to 1.3 billion of acquisitions. You have this really good chart in your deck, and I don't know if this plays into your investment criteria. Maybe you can go more into this, but you talk about, you look at the spreads, and based on the stoplight color, emphasizes how aggressive you want to be. Can you maybe walk us through some of this?
Yeah, we start with the lens of what we call our sandbox. There's two steps to making but into that sandbox. It's the top 30 plus or minus retailers in the country. One, we target recession-resistant retailers that sell critical goods and services. I have a rule: we don't buy anything where my wife shops. Number two, we're focused on retailers that are non-discretionary, non-luxury, and brick and mortar is a critical part of their omni-channel experience. I didn't have an opportunity to see the article you referenced in the Wall Street Journal yet today, but as I talked about on CNBC last week, brick and mortar, if you talk to all the retailers in our portfolio, is now the hub. And the spokes have now become BOPIS, same day delivery, next day delivery, lockers, all those other components. And so we start with that lens, and then with a bottom-up underwriting philosophy here. We buy rectangles. There's a great white paper on, and there's a number of them, but one specifically, it's called "Not All Rectangles Are Created Equal" on our website. If you just scroll down to the front page, we buy fungible rectangles here. Again, Kmart was the biggest retailer in the world. My dad developed 50 Kmart shopping centers across the country, up and down I-75. Every retailer goes bankrupt. People gasp when Jeff Bezos talks about when Amazon one day goes bankrupt, is no longer here. And so ultimately, we are a fixed income proxy with rent escalators. We're an unsecured creditor, just like the creditor unsecured bondholders of Walmart or TJ Maxx. We want to buy fixed income. We want to buy rectangles, fungible rectangles, for when and if those retailers aren't there, due to a bankruptcy, a non-renewal in a lease situation where they don't exercise an option, a rejection in a Chapter 11, that fungible rectangle has secondary uses and demand drivers. So you won't see us buy Topgolf, you don't see us buy car washes, you don't see us buy anything that we don't see secondary demand drivers, because again, Net Lease is a fixed income proxy. At the end of, assuming no default, at the end of a fixed income investment, you get the principal back. At the end of a net lease investment, you get the building back. And so we want to focus on those buildings where we're confident that those rectangles and major commercial retail thoroughfares are sized appropriately, are shaped appropriately, are scoped appropriately in terms of landlord investment and TI, and all those different things that drive demand ultimately there. And so we work from there. The top-down lens, 30,000 feet, that bottom-up underwriting, and what you see is the portfolio that you had a couple slides ago.
And obviously that leads to this, I would say you're in your second year of this, maybe more of this rethinking retail brand concept that you've been emphasizing, whether it's on your quarterly calls, on your presentations. You always mention about how this fits into your rethinking retail footprint. We're going to go into the Boot Barn, Burlington, the retailers that are listed here, because you have some great stuff in your investor presentation. But from a very high level, what is this rethink retail concept? Maybe a little bit different than what you've already talked about to this point.
You may recall 3 successive weeks in a row years ago. The Wall Street Journal's lead story was Amazon's going to kill auto parts, Amazon's going to kill grocery, Amazon's going to kill pharmacy. All 3 in a row. 3 successive weeks, front page of the Wall Street Journal. E-commerce is going to kill brick and mortar is dead, all of those noise. In 2017, maybe 2018, I went to the Wells Fargo Global Real Estate Conference, and in an interview on the stage, I said, e-commerce only is dead. To the gasps of the audience, the real estate institutional investors in the audience. I said, nope, you got it all wrong. Retail doesn't work when you ship for free and 40% of those goods get returned. It doesn't work. It's like the airline industry when it had to recalibrate and had to start charging for meals, start having drinks and baggage and all the other things. All those things couldn't be put into one. And so ultimately what we've seen in, I'll call it the past 10 years, just using round numbers, through all those headlines and all those noise, retailers investing billions upon billions of dollars in distribution, right? Direct to consumer, to store, hub, spoke, all of those different components. Losing money online to maintain customers in a totally price transparent world. This supercomputer in my hand can tell you the price of any good at any store in what, 10 seconds if you're quick, right? Add Amazon on there, it's even just use Amazon, it's faster. And so we have a world today where retailers poured all those resources in to maintain. It was accelerated by COVID, right? Accelerated and utilized by COVID. Today, every retailer you talk to is investing in stores. I've been to Lowe's, Home Depot, Tractor Supply, 7-Eleven, O'Reilly, Walmart. All of them want to open stores. Target, all of them want to open stores today, and every single one of them will acknowledge to you, and Boot Barn just did. You see them in the bottom of the left-hand corner. Their interim president, interim CEO is the former head of e-commerce, that the store is the critical linchpin for retailing today. Everything else revolves around the store. And so where we're moving, and to use a baseball analogy, maybe we're in the 7th inning, maybe we're in the 6th inning, maybe there's an extra inning, maybe it goes 10. We're in this place right now where retailers now have to incentivize customers to get their butts to the store, because labor, delivery, returns, all of these things just erode margins or net negative in an EBITDA basis. And so retailers have to drive you there through incentivization, through coupons, through direct offerings. They want you to bring their returns in so you repurchase. And so that omni-channel vision, which nobody had, the media exacerbated, the sell-side analysts, institutional investors, they all swing very far one way. It is Wall Street. They all swing very far one way. No one saw the longer-term vision. Hence to your initial question. We told everybody rethink retail. You're wrong. It's not going to work. These are all just components of a larger, broader strategy that's going to take years and billions of dollars to play out. And I think we're in the, I'll call it the last 3 innings ballpark there of that future really materializing. I'll give you one quick story. I think everyone will enjoy this. About 7 years ago, I was at a NAREIT. Probably saw you there, David. I was at NAREIT conference, the annual REIT convention in New York. An investor, he's in his 20s, an analyst at a large institutional, dedicated REIT institutional investor shop, says to me in a group meeting, "What are you going to do?" Quote, "What are you going to do with all of your parking lots?" At the time, you had 1,600 parking properties. "What are you going to do with your 1,600 parking lots?" And I looked at it and I said, "Sorry, I don't understand the question." He said, what are you going to do with all your parking lots?" And I said, "Honestly, I apologize. I'm not following the question. The tenants, as part of their premises, under the lease, net leases, they control the parking lot." He said, "Well, what are you going to do with all your parking lots once level 5 automation and ride sharing comes to fruition?" And I said, "Excuse me?" He said, "Yeah, once level 5 automation, self-driving cars, and then everyone doesn't need to own a car, they'll constantly be moving, they'll never need to park." And I looked at him, I said, "With all due respect, I'm from the Motor City. We are far from level 5 automation. Once we do achieve level 5 automation, the total addressable market is over assessed today. And I'm not sharing my car with anybody at that point. And so once we get to that point where we don't need our 1,600 parking lots, I'll be honest, I'm dead." But that's what the mindset of Wall Street was. And we looked at it and said, rethink retail. And you can see the white papers, the diagrams, the videos we have on our website that envision what that retail future would look like in an omnichannel.
And as you mentioned here, this goes back almost 10 years ago. Again, you said in your first quarter 2016 earnings call here about this, e-commerce.
Oh, yeah. There it is.
This is from your investor presentation. All right, so let's start talking about some of your winners. And, the number one company that you guys highlight in your presentation is Tractor Supply. Again, with this forward-thinking vision that you talk about, and obviously it's hard to use the crystal ball, but that being said, how
you don't need it.
I'm sorry?
You don't need the crystal ball, which amazes me with all management teams, with real estate REIT management teams and people who assess retail. I'm going to tell everyone the secret. If you walk into a retailer, and I'm stealing this from Hal Lawton, the CEO of Tractor Supply, who's obviously, let's look at this chart, done a tremendous job. If you walk into a retailer and the team members that work there are difficult to differentiate from the people that shop there, you're in a winner. If they are one and the same, you're in a winner. Tractor Supply, their team members are their core constituent shoppers. Chick-fil-A, their team members are their customers. Starbucks, got a little out of control, but their team members were their customers. Costco, have you ever seen anyone happier to give out samplers? Their team members are their customers. You go into these retailers where the team members and the customers are one and the same, right? We're all shoppers to some degree. But you go and again, I'm eliminating luxury. I'm eliminating, right, not these discretionary or experiential categories. But when you go into these retailers, the team members of their customers, the value proposition speaks for itself, right? They don't need to sell you. The experience itself, the merchandising itself sells the customer. The best retailers in the world, unless they have a very unique value proposition, Walmart, we're the cheapest and biggest, right? The team members are the customers. Trader Joe's, the team members are the customers. They cheer every morning when they get there. And so it doesn't take a crystal ball. It frankly doesn't take a level of intelligence that is overly accelerated or high here. But if you look at these things, same with Sunbelt Rentals here. The team members of the customers, they're in the equipment rental industry. They utilize equipment. They know how to do it. Home Depot, right? You find the Home Depot associates that know the store. TJX, they love the bargain hunt. And so, retail is not overly complicated. Driving to value propositions and seeing them is just the smell test at the end of the day.
Well, what about then Walgreens? Talk about the other side of the coin.
The team members aren't the customers. I mean, you have a number of things with Walgreens that are challenged. Number one, they overexpanded across this country without a value proposition. They have average Walgreens is 13,750 feet, 13,800 feet. Let's round up. About 1,800 feet is dedicated to the pharmacy. Obviously, we have pressure on generic drugs coming from multiple areas. COVID had a spike, obviously. But now let's talk about the other 12,000 feet. Why go into the other 12,000 feet? When I need toothpaste, I hit order again on Amazon. It shows up the same day or next day. It's cheaper than Walgreens.
You order your toothpaste on Amazon.
Order again, Colgate Plus or whatever it is. It shows up the same day or next day on Amazon. A lot of them I have monthly subscriptions for. I don't want to have to go out there or come every 2 months. You pick the recurrence. You can skip a delivery. I don't have time. Frankly, I don't have time, energy, or the effort to want to go in there.
Was this the mindset that you guys were using in 2012 to, when you started calling the portfolio? Was this that mindset, or was it diversification at that point?
It was diversification, and then it was all diversification. It also morphed into the mindset to continue that. I mean, Walgreens is not happy with some of these quotes. I've heard from them directly, frankly, that I've said on the earnings calls you see there. But what's the value proposition? You need chips, drinks, snacks, candy. Do you go into a Walgreens anymore? You go into the dominant C-store, Wawa, Quick Trip, Sheetz, 7-Eleven, Maverick, Come and Go, Quick Trip with a K. They're better operators. They're in, they're out. And then if you look at what Walgreens' strategic challenges have been, they've been self-made. So first, the Italians took over the company, and they basically said, you know what, we're going to bring cosmetics and fragrance like we do with Boots Alliance in Western Europe predominantly, where women are accustomed to shopping there for fragrance and beauty, and put it in stores. Down the street, there's a Walgreens, mile and a half. I can see it from here, not even a mile and a half, a mile. They put this beautiful 1,500 square foot cosmetics and fragrance in their section. Probably spent $1 million, $1.2 million, dead. What they didn't understand is women here went to the department store historically. That's why it's on the first floor. It's got the largest margin. And then Ulta and Sephora opened up here. Didn't work. Then Walgreens said, you know what, we are going to open the W cafes. You may have seen them mostly in urban or college towns. We own the flagship Walgreens still in Ann Arbor on the corner of the Diag. It has it in there. We're going to have soft drinks from a fountain and Slurpees, yogurt machines, quick grab and go food. But they didn't staff accordingly. So to operate those machines, they break, they need refill, and they create spills and hazards. They didn't staff them accordingly. They turned into a disaster. They all failed. And so Walgreens has never, while CVS was becoming a vertically integrated healthcare company, Walgreens has basically tried these different strategic maneuvers that have all failed. And now you see them culling all of these non-core businesses that they tried to bolt on. At the end of the day, the pharmacy space is akin to the movie theater space in this country. It's not going away totally, but we have way too many pharmacies and way too many movie screens. We saw Rite Aid file bankruptcy. They'll file bankruptcy again. Walgreens will close thousands of stores. Most likely will end up in bankruptcy in Chapter 11 in the next 3 to 5 years with their cash burn. But these long-term lease liabilities and the eroding front-end margins of the store and sales of the store are just destroying them.
Do you think the Amazon pharmacy is going to cannibalize or make more of these Walgreens and CVS stores close as well?
I think retail is competitive. I think you can script from Amazon. You can do it from Mark Cuban startup. You can go to Costco. You can go to Walmart. You can go to the grocery store. It's a competitive business. The intent of the pharmacy, the freestanding pharmacy, is that was a leader for you to buy goods in the front 12,000 feet. I said on the earnings call a couple of times now, I go to Walgreens 3 times a year besides picking up a script, or a pharmacy, frankly, 3 times a year at CVS. My wife's birthday, our anniversary, and Valentine's Day to buy a $9 greeting card.
I go to the grocery store personally, but I hear you.
You probably should. I went into Five Below and they were $1. And I'm like, what am I doing? I mean, so.
By the way, if you can bring Wawa to me in Texas, I would be one happy camper, because you talk about good quick service rest sandwiches.
They're coming. They're coming. Look, they're coming. Texas, you got Buc-ee's, right?
Buc-ee's, absolutely.
Who's absolutely all these regional operators, a couple national, Casey's, 7-Eleven, and slash Speedway. They're challenging the front end of pharmacies. They're challenging the fast food operators, the quick service operators. They're challenging all of them and taking pieces and parts of share. But share isn't binary. Pharmacies aren't going away. Movie theaters aren't going away. They'll just be rationalized.
So are you getting into the Buc-ee's business? Is that what you're saying?
We would love to do business with Buc-ee's. We've talked to them multiple times, and they say, we don't need you alone.
All right,
amazing operation. I was actually just in the one in Springfield, Missouri 10 days ago when I visited O'Reilly's headquarters.
Did you get some beaver nuggets when you were there?
No, I literally just stood in the middle of the store at all. Just absolute awe. 40 pumps and dispensers. I mean, it's just the jerky section alone is something to behold.
Good barbecue sandwich. You should try it sometime. So let's talk about 2 of your components. You briefly mentioned your DFP, the developer funding programs. I want to talk about that. But also, you have this ground lease program that's a little bit different than a lot of the other players that are out there. Can you maybe walk us through both of those functions?
Our developer funding platform takes private developers' projects and brings them to fruition, either through our capital stack. We'll provide the capital and own it upon completion, or we'll take it over and they can get out of the way and we'll develop it ourselves. So acquisitions, developing funding platform, all targeting the same retailers. That sandbox of 30 plus or minus, just another mechanism for us to get our hands on them. Our ground lease, I wouldn't even call it a platform. It's a component of our portfolio, approximately 11%. There's another white paper on our website. Nothing is free except a building at the end of a ground lease, where we own the dirt, and Wawa, Walmart, Lowe's, Wegmans, Home Depot, BP, Thornton's have built and paid for the building on top of it. And if they ever leave, we'll take possession of it for free. And so from a risk-adjusted basis, I think it's probably the greatest investment in that lease.
I know it's a different universe, so I'm cautious as I ask this question. Besides the asset itself, is there any real difference between, let's say, your ground lease program and like Safehold's?
Totally.
Safehold's
Fundamentally different. Fundamentally different.
In terms of what? Property, contract size, lifespan, what?
Everything. Safehold is a financing mechanism where an existing owner of a property, a hotel, an apartment building, I don't think they do much retail, will ground lease right? We'll sell the fee interest to you. You will ground lease back to me, the owner, for a long-term ground lease. And then I will go finance the building, the improvements, which I still own. So 1 + 1 will hopefully equal more than 2 in terms of proceeds.
And what's the term? Is it 99 years type of thing, or is it shorter?
Yeah, generally. It's a financing mechanism. It's called splitting a lease, right? It's splitting the ground lease and the fee simple. We're just buying third-party leases. We're buying, David, you own a piece of dirt that is ground leased to Lowe's. Lowe's built their building. We're buying the dirt from you. Lowe's is still there. That's it. So there is no splitting of a lease. Typically, ground leases materialize. Again, this is what I worked on before I came to Agree Realty. Ground leases materialize because the largest real estate owners in the world who prefer to own still don't own approximately 20% of their real estate because the owner at the time said, no, I'm not selling, you can ground lease. Or if you don't ground lease, Target's ground leasing at Walmart. Or if you want it, Lowe's, Home Depot, you want it, you got to ground lease. And so they're kind of created by mandate. Again, those are the largest commercial real estate owners in the world, retail. So they own 80% plus of their stores, plus minus, depending on the retailer. These are the rare instances where they do not own the actual dirt. They just own the improvements. If they can take it with them somehow at the end, Elon can figure that out for them. Feel free.
Okay. I know we've talked about the backstory, the current story. How about the future story? Do you think it changes much if we had to look 20 years down the road? Do you think it's going to still be what you see today is what you're going to see tomorrow?
No. And in full transparency, our long-term planning here is 3 to 5 years. This is, I had the luxury of growing up in this business with 2 at the time perceived blue chip net lease companies, Realty Income and National Retail Properties, now Triple N. Take the pieces and components of both of them. They've gone in very divergent directions. Take the pieces and parts that I liked from both of them, shape and mold it, and put our perspective on it as Agree Realty. The net lease space is the largest commercial real estate space in the country. It is the most fragmented commercial real estate space in the country. It's the most diverse commercial real estate space in the country. Right? I mean, how many different opportunities can you conceive of? We can create a net lease on anything. We've done it with condoed interest on first floor retail. All of Manhattan is basically condoed interest, first floor retail. We've done it, we buy Chick-fil-A's that are 1,800 feet and Walmart supercenters that are 220,000 feet. So 20 years from now is too long to even think about what this company becomes. Today, it's an $11 billion organization, or just about $11 billion organization. Size has its benefits, but size has its limits. We have unique attributes of this portfolio. But I would tell you, there is a threshold where size becomes a challenge. I think we see some peers experiencing that, where diversification, I'm a big Munger Buffett fan, diversification actually equals worsification. We're going to focus on the continental 50 United States, the biggest and best retailers. We're not going to Canada, Mexico, let alone Europe. We're not going to buy casinos, industrial, cold storage, vertical farming, or anything else that we've seen peers go into. But there is a point in time where size makes you change your investment criteria. We're nowhere near that today. This will be a $20 billion enterprise. It will be sometime between most likely 2 and 4 or 5 years. It's inevitable, right? We got a $2 billion war chest today. Markets will go up and down. We'll see. That'll probably drive a lot of it. Opportunities will. But there will be a point in time where it makes sense for maybe our ground lease portfolio to be its own separate entity. We're TJ Maxx's 3rd largest landlord today. We'll be their largest one day. We're Walmart's largest landlord in the country. Maybe there's a Walmart REIT. These are all just creative ideas. There's nothing specific obviously happening here, but eventually you lose your discipline. You start to worsify because you have to expand beyond your core competency. I get the question all the time, will you buy a industrial facility leased to Walmart? No, I will not. I don't know anything about industrial. I built a team that doesn't do industrial. We specialize in retail. and Wall Street would kill me, right? You don't get the benefit. So there will be a time, it will be before 20 years ago, where we make strategic changes because we'll learn the lessons of those before.
I guess maybe using that 20-year vision, and I know it's hard to kind of predict what's happening tomorrow, let alone 20 years from now. But like, do you, again, top tenants that could change?
Will change.
I'm sorry?
It will.
Your retail sector focus obviously could change. You know, your positioning obviously could change. And as you mentioned, when you look at some of these your bigger brethren peers that have merged with other companies just to grow, as you called it, a worsification, that's kind of why I asked that question. And it seems like, no, you're sticking to your principles and it's not going to change fundamentally. But
it's a lot different when your name's on the door. You got serious skin in the game. Your family and board member have bought $20 million in the open market in the past 18 months, and your family's never sold a share of stock. So
imagine what Christmas dinner conversation must be like with the family get together.
This is not a game for me. This is a business. This is blood, sweat, and tears. And I will never put this company in a position to degrade value. That is my line. And if it ever came to that position, I ever came to that apex, I've been very clear with shareholders across the board. I will no longer be here.
We'll find you at Pebble Beach.
No, I don't golf. I don't have any hobbies. That's part of the problem.
I know you're not a golfer. All right. So you briefly touched upon your peers. And I know you don't want to necessarily go down the road, but like, what does set apart Agree from a Realty Income, a Triple N, a WPC, some of these, Essential, Net Street, some of these other players that are out there? Again, I know size is one thing. We've talked about the Rethink Retail, which I think is the sweet sauce, but again, what differentiates you guys from a lot of these other peers in the sector?
I don't think we have anything in common. I'll be honest. I think name me something in common. We transformed balance sheet management in this space by inventing the forward equity offering. I took all of the bumps and bruises along the way when I decided to do that. I came up with it actually laying in the hospital with a non-critical injury because I can't think of anything else. 90% of equity raised in the space since we did it, and I got personally obliterated for it. Then forward equity. Our balance sheet management philosophies have been totally different. They've been copied by all of our peers today. Our approach and discipline is totally different. We stick to that top 30 sandbox. Nobody else has. They've tried to mimic it, but they ran up their Dollar General and Walgreens exposure just to check the proverbial investment grade box. Everyone focuses on investment grade. It's pretty funny. I can name you some of the best retailers in the country that aren't rated. Yeah, we're 69% investment grade, but Hobby Lobby's not included in that. Joann's going to go away now, finally. Michael's is struggling, and David Green is a multi-billionaire with no debt. We were talking about a company that made $2 billion, and he gave away $1 billion to charity. And so Publix is a pretty good grocer. If you haven't been to one, they're a pretty good operator, don't have a credit rating. So is Market Basket in New England. Chick-fil-A is a pretty good fast food operator. If people haven't noticed, doing $10-11 million AUV a year now. I mean, they made Ronald McDonald to put him in the dust. No credit rating. So is Tractor Supply when we invested in them. So is Gerber Collision today, which doesn't have any long-term debt. And so we've never taken that myopic view. The best retailers, most of them have credit ratings, but they don't. We haven't worsified or diversified, whatever you want to call it. We've stuck to our knitting, our core competency. We have always pre-equitized our balance sheet, inclusive of forward X starting swaps. We have 200 million swapped at 3.7% today and over 900 million in forward equity outstanding. Not sure what other REIT management teams were thinking when the 10-year was rising, not tapping the equity markets. We double tapped them. We have a very discerning, and again, when your name is on the door and you won't take outsized risk, this is a singles business. I want to be Ichiro Suzuki or Ty Cobb. I don't want to swing for the fences. I want to hit a single just a straight little shot to the outfield between the right fielder and center fielder, or left fielder or center fielder. I'm not trying to hit a double. We're not trying to hit triples. And we certainly aren't swinging for the fences here. Every year we can provide mid-single digits, subject to the macroeconomic conditions, AFFO growth with a growing and conservative dividend, driving to double-digit total returns with a fortress balance sheet and the best portfolio. We're not going to do anything to screw that up. That's the bottom line. Markets will come and go. Interest rates will fluctuate. Macroeconomic circumstances will deviate, force people to deviate their past. We're going to do the same damn thing, rinse and repeat 400 times a year. And that's how many transactions we'll probably do this year.
And that's where we should end the webcast, because that's, we're not going to, but like that's the meat of it right there. That's the why of ADC right there. So I love that. You briefly mentioned Joanne's closing.
This is the least sexy business there is. Point blank. Sell the hamburgers, sell the French fries.
Slow and steady wins the race, my friend.
That is it. And real estate, 99% of real estate is hit the home run, refinance it, public real estate, right? Inclusive here, private real estate, inclusive, sorry. Sell it, hit the home run, 99%, put the chips back on the table. This business, we always hold our chips. We don't put chips on the table. We're the bank, we're holding our own chips. And so at the end of the day, that conservatism, which runs frankly from my father, who never believed in home mortgages if you couldn't afford it, if you could afford your own home, to never put your family at risk, who raised me with the notion that any loan with a maturity, any loan that wasn't self-liquidating was a quote unquote bullet loan, not a maturity. It was a bullet. So today, those lessons stand very strong here. And he still comes into the office, enjoys hanging out with the team here, gives wisdom, guidance, mentors young team members. And so that's the DNA of this company.
Does he ever come down on you? Like, what are you thinking? What are you doing? Like, what are you, stupid? Does he ever father you?
No. He has had, not sure why he turned the reins of a publicly traded company over to a 26-year-old, but he has more than enjoyed the ride, and he's participated in it. He turned 81 last week.
He's done pretty well under your tenure, I would say.
Yeah, but the lessons that he imparted upon me literally lived through this company this day. We don't have any debt maturing until 2028 except $50 million. We have no variable rate exposure, right? Those bullet loans my dad was talking about, those are triple B plus rated paper today with de minimis maturities relative to our overall balance sheet that are well staggered. And so those lessons live through today. They're the DNA, like I said, of the company.
Shifting gears a little bit, you mentioned Joanne's closing. We saw Party City issues last year. Everybody always talks about their tenant watch list. Oh my gosh.
Yeah.
With you having so many properties and so much exposure, what makes up your watch list today? Is there anybody that concerns you at this moment in time?
Material? No. We're working through the few big lots that we have. We'll see what happens with the gyrations in that bankruptcy. We bought the lease in bankruptcy with that auction for $250,000, and we'll double the rent. So the basis on those are so low. You can't build new products in this country today. It costs $160 a foot just to build an off-price Burlington box, vertical alone. That doesn't include land, soft costs, site improvements, interest expense, brokerage commissions. I mean, we start deporting people in this country as well. We are not going to see construction costs go down.
And that so 250 is like what, de minimis to FFO or anything. I mean, it's like non-existent, not even a tenth of a penny, right?
Which one? Which piece you said?
The 250, the big lots lease that you just acquired for $250,000. You said, like,
in terms of
FFO, it's like nothing, right?
No, that's nothing. But we've already leased it. I announced on the earnings call we've already leased it to an off-price tenant, paying double the rent for big lots with no TI or landlord work. So, I mean, we wanted to control the space so no other retailer bought it. There was a furniture operator, regional, that wanted to buy the lease, and get in there for that historic Big Lots rent. We said, no, no, no. So we entered the auction. So no, we don't have any Joannes. That they're back in 11 after probably the dumbest retail bankruptcy in the history of retail bankruptcies. They took no prepackaged bankruptcy, didn't reject any stores, and took no shots at the landlord for rent concessions or reductions during a bankruptcy. That thing will probably liquidate with Gordon Brothers being the stalking horse. Look, we are exiting today a super cycle of interest rates, right? That is now over. We are entering a post-COVID world where sales were skewed and now sales are normalizing, as well as a world, an omni-channel world where low-income consumers are struggling because the pace of inflation outpaced their wage growth. You take those three things, you put it together, the delayed bankruptcies because of the cheap money of that super cycle, a strained lower-end consumer, and now a rationalization of those retailers that was delayed by COVID and a normalization of sales. And we're going to see retail bankruptcies. For a while, no one ever went bankrupt. They had free money. They became SPACs. They did all these things. Now we're going to see that come. So get ready for at home. They're going to go away. Top Golf being spun out from Callaway, which thought it was a great idea to have an entertainment experiential facility or arm. We're going to see those bankruptcies come back. Watch the pet guys. Petco isn't probably too long in the tooth today. Difficult business. And you can go across those sectors and look. The office supply guys, we still got Depot Max Staples. I mean, we need all that? I don't think so.
Okay, one of the things we constantly hear is that, oh my gosh, REITs are interest rate sensitive. REITs are bonds, they trade interest rate sensitive.
Course.
Are you guys interest rate sensitive? Do you feel that what's going on in the world of the 10-year, the Fed funds rate impacts you dramatically? I know you mentioned 50 million of that coming due in 28, but besides that, is there, do interest rates impact you guys?
Well, look, any yield-bearing investment, interest rates have an impact, right? There is not correlation, but causation. But when you pre-equitize your balance sheet with over $1 billion in forward equity, and you don't need to access, and then you swap the 10-year at 3.7, I think you're in a pretty good shape, irrespective of where, frankly, rates go. And I'll tell you why we did it. I'm sitting here in Michigan. When Dearborn was voting for Trump, my wife's friends were asking, is she voting for Trump? The union members, not the rank and file necessarily, were voting for Trump. You could hear them and see them. I said to myself, Kamala's not winning Michigan. This isn't a battleground state. She's not winning Michigan. This is over. And we're going to see the 10-year yield spike. And so we took that opportunity, like I said, to double tap the equity markets, raise up $900 million in Q3 and Q4 in forward equity. We don't need $1 this year to hit that number of 1.1 to 1.3 or even higher and stay lower than 5 times net debt to EBITDA. So of course, generally speaking, REITs are interest rate sensitive. At the same time, not all REITs are created equal, right? If you look at the overall just refinances in the course of the next 3 years, the average REIT has a point of refinancing headwinds over the next 3 years. That was calculated before the 10-year was at 4.6, let alone 4.8 10 days ago.
I'll say 3.7 seems like a friggin', I mean, it wasn't that long ago, but it's at this point, it seems like a lifetime ago where we watch things. You briefly touched upon it. We touched upon, Realty Income, Spirit, M&A. Mm-hmm. Is there an M&A opportunity? Should rates reset here for you guys? Do you see any interest taking out one of the smaller peers that's out there, or is it just not fit the sweet sauce for you guys and therefore it's out of the bubble?
We don't need rates to reset. We have the liquidity and balance sheet if we wanted to. We traded a premium multiple to those operators if we wanted to acquire them. Whether it was friendly or hostile, I'll be honest, the biggest challenge for us is that they all diluted the quality of their portfolio to drive earnings growth when cap rates were low. Taking your portfolio to 12% Dollar General and 16% pharmacy and 10% Walgreens, they're all suffering and paying the price. Most of these small cap or micro cap peers, we could assemble their portfolio in the course of a year at a better price. We are just unwilling to take on historical exposure from these companies to drive short-term earnings with non-fungible boxes, poor credits, or tenant exposures that we think are out of whack. Again, we're in the largest and most fragmented commercial real estate sector. There's plenty of opportunities. We don't need to buy anybody to hit our numbers.
They're great stuff. All right. You mentioned the dividend. That was one of your core drivers. What would be the keys to dividend growth? Because for us as ETF issuers, I mean, we care about our constituents continuing to grow their dividend. So if I'm a shareholder in ADC, how do I keep growing? How do I see my dividend continue to grow?
It's easy. We drive AFFO growth and we raise the dividend. We raise it twice a year, Q2, Q4. The key to dividend policy is transparency, predictability, right? And that's what we've done. And so it's a monthly dividend, and Q2, Q4 raise pattern will continue.
I forgot to point that out, that you are one of the handful of guys that does pay the monthly dividend, and we know how much retail, especially investors in general, like seeing that monthly component. All right, my last question for you. If you could leave one last message for a REIT investor in 2025, it would be?
Invest in the best. Pick the best management teams. Don't look for high yields. Don't look for value add stories. Invest in the best. Nobody can sit here and tell us what's going to happen around the corner throughout the year. I never would have predicted the tale of 2 years last year, right? We were prepared for the do-nothing scenario. Invest in the best. Pick the best management teams out there, whether it's in retail, net lease, industrial, apartments, and invest in the best. And those companies in the long term win. Look at the 10, 20-year returns, the long-term returns. It's better, and you'll see. But if you think a high yield looks attractive, it's high yield for a reason. I'm leaving this conversation, going to Boston for a roadshow. I'll be at Fidelity, and I'll be at Fidelity and Wellington, all the large Boston investors, and then over to Baltimore to see T. Rowe Price. REITs are all about the virtuous cycle. Being expensive is good. It lowers your cost of capital. It enables you to accretively invest that capital to drive AFFO growth, to drive dividend growth. When you don't have a cost of capital, you have to get outside of the playing field or your box and take risks. And those risks, ultimately, I've never seen it not come back to bite a REIT. And so expensive, good. Cheap, bad, unless you're willing to sit there and wait for years and years and years for a takeout. But I'll leave you with the final thought. No net lease REIT has ever come back. There's one net lease REIT that went from low double-digit multiples to 20 turns, over 20 turns, to where we trade today, and that's Agree Realty. No net lease REIT has ever come back from a compressed valuation, including the ones that the turnaround king, Glenn Rafrano, ran. Jackson Shea came in to run Spirit outside the dividend, had zero returns on a cumulative basis. You don't bring them back. Once you're in the penalty box in the public markets, unless you invent a new product, right, or a new widget, you're staying in that box for good. It's not a 2-minute penalty. And so expensive is good, cheap is bad. Pick the best team or management teams out there, and trust them to do the right thing.
Are there any questions from our audience here for Joey before we let him move on his way to Boston? Jeff Brand, I know you've got a question for Joey, my friend Jeff.
Oh, not today. I thought it was amazing. I've learned a heck of a lot, and I love listening to him because I just hired 2 people from Spirit, a matter of fact, because they recently.
Well, they can give you the firsthand knowledge. I go back to Tom No. The irony is sitting here at 46, I'm the longest tenured CEO by more than double now, I think, in the net lease space. And I've been friends and still keep in touch with some of these former CEOs that they look at these companies that they used to run and say, where did they get lost? But look, Spirit never came back, right? They went overexposed. Perfect example. They went overexposed Shopko. It bit them in the ass. Shopko filed bankruptcy. They brought in Jackson Shea to turn it around. Jackson spun off Shopko, right? Got a little bump from it, said, okay, now we need to start growing. And if you look at their largest investments, and I'm not sure how the golf courses do, but I don't believe in net leases on golf course. Party City, boom, bankrupt. Huge deal for them. Including Anagram, the balloon, right? The balloon manufacturer the Party City owned, also filed bankrupt, which was mission critical. And At Home. Look where At Home's bonds are trading and cents on the dollar today. At Home has never made money outside of COVID besides sale leasebacks with Spirit, literally. So you have to, it's the perfect example of having to trying to drive earnings by going outside, and you do not want an At Home back except ours in Provo, Utah, which we bought as a real estate play. It's 86,000 feet on Main and Main. You don't want an 86,000 foot box back in today's world. And so that's the perfect example of just never getting out of the penalty box. Same with the ARCP, right? I mean, Nick Scorch led it into the penalty box. They hired Glenn Rafano to get out. The stock got one above $11, didn't raise enough equity, and they got lucky with Realty Income behind them. So it's your team members have seen it firsthand there. You just can't put yourself into that box.
Well, I thought was most interesting of what you talked about relative in spirits. Another, just not to keep beating them up, but I mean, one of the women, when they got acquired by the group in Arizona, that's when they laid off a bunch of people in Dallas, where I am, and that's where I got these people from. But what's interesting is one of the women's I met with, her whole job was to essentially set up sale leasebacks with private equity firms.
Yep.
And she was buying assets that were like in the middle of nowhere for like farm implementation companies. And that's, so what you're talking about, high quality, is it further says to me what you're doing is the right thing versus trying to get yield, because they're getting high yields. They're buying these at like 8 to 10% yield, but they're junk. I mean, what happens when someone leaves that warehouse in the middle of nowhere that makes farm implements? You're never going to replace that income.
Jeff, we've seen it with car washes across this country. We have an avoidance of private equity sponsorship at our deck. It's a misalignment of interest. There's been articles galore and analysis galore about car washes and private equity. Everybody from Warburg Pincus to KKR to Leonard Green, all rolling out car washes for monthly subscription models. The largest unsecured creditors for all of these car washes is REITs. At the end of the day, they're doing sale leasebacks that's based upon EBITDA coverage of 3 times EBITDA for 120 to 140 square foot, 120 to 140 linear foot tunnels that are single purpose buildings at the end for 100 basis point premium. When at the end of the day, you're back to dirt value, which is approximately on the average real estate investment outside of inflation or appreciation, 25% of the overall investment. Is that worth 100 basis points to anybody? No. But there are funds, REITs, that have to deploy that capital, and you get this pricing skewed, plus the accelerated appreciation because someone thought car wash equipment needed to be accelerated more quickly. You get these skews in these markets that aren't true real estate investments. They are spread investments, and the management teams, I think they just say, well, we're not going to be here when that tenant's gone. It's not going to be ours to deal with. Goodbye. Now, Agree's still going to be on the name of this place, knock on wood, and hopefully I'll be here.
It'll be Joey Jr. running it by that point.
It's 11 and 13. I don't know about that. They got a lot of work. They got a lot of work to do, and then they're going to have to earn it. I started sweeping houses when I was 15 under construction.
Joey, thank you so much for this. For those that are
pleasure.
listening, Agree reports earnings on February 11th after the close. Get ready for a fun, exciting earnings period, as well as 25 guidance. And Joe, I look forward to seeing you at the REIT conference circuit this year and catching up with our Army friends as usual. So thank you so much for joining us today. I really appreciate it.
My pleasure. Thanks, Fred.
Great seeing you, buddy.
Very much.
Thanks. Bye.